Thank you so much, and thank you all for having me. This is pretty fun to get to present to an audience that I normally don't get to talk to. So it's a lot of fun. So I am Kevin Mullally. I This is my fifth year here at UCF. I was promoted last year, so first year here as an associate professor. Prior to joining UCF, I was an assistant professor of finance for 3 years at the University of Alabama. And my educational background is I went to school here at UCF as an undergrad in the early 2000s, and actually graduated with a degree in mathematics education, and then pursued my PhD and my master's both from Georgia State in Atlanta. And on the research front, I primarily study institutional investors, so mutual funds and hedge funds and pension funds. And I primarily use them as a laboratory to just look at various economic theories and economic questions. And so specifically, my research is sort of focused in on two areas. The first of which is the impact that compensation, the amount, the structure, and those sorts of things has on investment performance. And then more what I'm going to talk about today are how funds respond to disclosure requirements. So if we force a mutual fund or a hedge fund to disclose certain information, what is the quality of that information? How do they manipulate that information? Those sorts of things are what I find interesting and what I study. So as far as collaborations go, I largely work with people that I went to graduate school with. And so those people have ended up at places like I have a colleague at the University of Florida right now. I have a colleague who's at Peking University in China, and collaborators at Northeastern, University of Arizona, Boston College, Georgia State, where I went to school, places like that. So primarily that's where my collaborators come from. As I mentioned, again, sort of some of my big picture research questions are to understand how and why incentives influence performance, to understand how economic agents behave when forced to disclose information. And the way we typically do things in business is I try to identify or scrape new data sources, collect non-standardized data, and then just analyze it from a statistical perspective. And I can draw inferences in that way. So as far as impact and outcomes and things that I'm proud of, I've published in several of our top tier finance journals. So the Journal of Finance, the Journal of Financial Economics, and I'm crossing my fingers for the Review of Financial Studies, as well as Management Science. And more importantly, for me at this stage of my career, I'm fortunate enough to have been covered in a lot of the business press. So my work has been covered by the Wall Street Journal, Forbes, Bloomberg, Pensions and Investment, Institutional Investor Magazine, and I've really tried to seek out opportunities to present my research at practitioner conferences as well. So those are the things I'm trying to focus as I move towards the second stage of my career. So what I'd like to talk to you a bit more about this morning or this afternoon is one of my recent papers on disclosure. And so kind of the way I set this up is that asset managers like mutual funds are forced to disclose a lot of information to the public. So they have to disclose things like their daily investment return, their fees, how much they charge, who's actually running the fund, their portfolio managers. They have to disclose the stocks that they hold at certain horizons. And the reason for this, as you can imagine, is just transparency in the financial markets. So if I want to invest my capital, I'd like to have a good sense of who I am investing it with and the types of assets that they are investing it in. And so it just promotes trust and transparency in these markets and hopefully gets capital flowing from investors to spenders more freely is the idea there. All right. And so what I'm focusing in on a recent study here is the fact that mutual funds are required to compare their investment returns to a benchmark index, say the S&P 500 or something like that. And the rationale behind this is pretty straightforward, right? We want to be able to determine whether or not an asset manager is actually good at investing. Okay. And so if I ask the audience here today, am I good at basketball? Right? That's a bit of a tricky question because I'm good relative to something else. So if I ask you if I'm good relative to an NBA player, your response is probably not. But if I ask you if I'm good compared to my 8-year-old daughter, I'm 6'4", by the way, you can't see this on the screen here, your answer would probably be yes. And I would obviously be able to beat my daughter pretty easily. And so that's kind of the issue that my co-author and I are getting after in this study. So what are the rules? This is where it gets a bit interesting for me as an economist. What are the rules about what funds have to do? Well, funds are allowed to choose and change the benchmark that they compare themselves to. Okay? And so there's little scrutiny in these choices, and there's no requirement to discuss any changes they make 1 year after they make the change. And I'd like to show you an example of sort of the data that we've collected and what this looks like, because it'll really illustrate the issue at hand. All right, so I'm going to show you the example of the Goldman Sachs Capital Growth Fund. And this is the data we collect. This is from their what we call prospectus, their disclosure to investors in 2016. And so what you can see here is that you can see the return of the fund itself. They earned 2.33% in the past year, and they compared themselves in that year to the Russell 1000 Growth Index. And what you can see is that they underperformed that index by about 5%. The index returned about 7%, and this fund returned about 2.3. Okay, so that's obviously not a particularly favorable comparison. We would like to outperform. I would like to invest in funds that can beat the market, so to speak. So again, there's the same disclosure. And here's the disclosure in 2017. And so what you can see that year is that they still are disclosing this Russell 1000 Growth Index, but they've added a second index, the Russell 1000. And so what we can, you can very quickly see there is that the return on the Russell 1000 is lower and very significantly so, the Russell 1000 Growth Index. Right? And so the 1 year difference is about 8.5%. And if I accumulate the difference over 10 years, it's really large, right? The difference between those indexes is over 30%. The fund doesn't provide any justification for why they're doing this, and they don't even change their investment objective sections. There's no reason. They're not changing what they invest in or anything like that. It appears that they're just doing this to make themselves look better. And here's the really kind of nefarious part about this. Again, here's the 2017 disclosure. And then in 2018, what you can quickly notice is that any reference to the original benchmark, the Russell 1000 Growth, is gone. And so in essence, this is what this paper is about, is documenting this behavior on a systematic basis. And so what we're finding is that on average, when a fund changes its benchmarks, they're adding benchmarks that have lower prior returns than what they used previously. Okay. And this obviously matters a lot to investors, because investors are going to be using this piece of information to base their decisions. Right? They're going to presumably allocate money to funds that have outperformed, or at least appear to have outperformed, their benchmarks. So what are the takeaways and the applications to this? Again, in general, what my research has shown is that asset managers are going to respond to disclosure requirements strategically and opportunistically. So if I make them choose a benchmark, they're going to choose one that's favorable, and they're going to hide comparisons that are unfavorable. If we make asset managers disclose the stocks they hold, well, what they're going to do is what we call window dress. They're going to make it look as if they chose stocks or held stocks with high past returns. And so the takeaway or the application, I hope, for investors and for plan sponsors and folks of that nature, is that they should be aware of these incentives and then take them into account when choosing funds or managers. And then briefly, since I have about 2 minutes here, my other main area of research is focused on compensation incentives. Right? And so the application here is there a way for employers to design these packages, right, to incentivize good performance, especially in tasks like the one we all work in, academia, creative type tasks? And so another study I did recently is we studied this question in the setting of public pension plans. And so what we found was that if you pay a manager more, you can attract and retain better managers, those with better qualifications, those from better universities, that sort of thing. But interestingly, paying them direct incentive compensation did not seem to correlate with performance. And the reason we posit for that is if I ask anybody in this room to generate 2 top-tier publications in the next year, I can incentivize you to work on it, but it's a lot different than incentivizing that actual outcome. It's much harder to incentivize outcome than it is effort. Okay. And so our sort of solution to this problem is when you pay somebody more, you're likely to retain that good person. It seems to be the optimal strategy here. I have a bunch of other research ideas in mind. One that I'd like to do at some point in my career relates the introduction of standardized testing to sort of economic outcomes. So if there's anybody in the room who happens to be in the College of Education and knows anything about that, I'd love to chat. And certainly, I think there's applications in what we do here in finance with certainly what folks do in computer science regarding AI and non-standardized data collection and that sort of thing. So I'll stop here. I think I'm out of time. I see that there's a bunch of questions in the chat, so I'd love to take those questions, as many as I can here in the next 5 minutes.